All right, let's talk about one of the biggest, most fundamental ideas in all of finance, the market index. You know, you hear it on the news all the time. The market was up today. But what does that even mean? Well, stick around because we're going to break it all down.
Okay, so here's what we've got on tap. First, we're going to tackle the big one. What is a market index anyway? Then we'll dive into the two different ways they calculate returns. From there, we'll get into the real secret sauce, weighting. We'll also look at how these things stay up to date. And finally, we'll wrap it all up by showing you why any of this matters to you as an investor.
So let's just jump right in with that first big question. I mean, we hear it constantly, right? The market is up, the market is down. But what is the market? Is it one thing? A place? What are they even talking about?
I mean, just think about it for a second. There are literally thousands of stocks trading every single day. How could you possibly keep track of all of them to know how things are going overall? You can't, right? It's just too much. We needed a shortcut, a quick snapshot, and that is the exact problem that market indexes were invented to solve.
Okay, so here's the textbook answer. A security market index is basically just a hand-picked portfolio of stocks or bonds or whatever that's built to represent a whole market or a piece of a market. The best way to think about it, it's like the market's report card. It boils everything down to a single number so we can see how it's doing at a glance.
Okay, so we've got a handle on what an index is, but how does it actually tell us if the market is up or down? Well, it turns out there are a couple of different flavors of performance, and believe me, knowing the difference is absolutely crucial if you want to understand real investment growth.
All right, this is super important. You've got two main types. First, there's the price return index. It's simple. It only looks at the price of the stocks. Did they go up? Did they go down? That's it. But then you have the total return index. This one tells a much fuller story. It doesn't just track price changes, it also includes all the income you get along the way. We're talking dividends, and it assumes you reinvest them. It's the whole package.
And you can see the difference so clearly right here. Over time, that reinvested income, those dividends, they really start to work their magic. That compounding effect causes the total return index to just pull away from the price return one. See that gap between the two bars? That is the power of dividends. That's real growth that you'd be missing if you only looked at the price.
Okay, now we're getting to, in my opinion, the most critical part of this whole thing, the secret ingredient, weighting. It's all about how an index decides which stocks matter more than others. And let me tell you, this one decision can totally change the story the index is telling you.
So first up, we've got the old school method, price weighting. You've definitely heard of the index that uses this one, the Dow Jones Industrial Average. The logic here is super simple. The stock with the highest price per share gets the biggest voice in the index. That's it. It doesn't matter if the company itself is huge or tiny, it's all about that share price.
So, using that method, our little sample index here gives us a return of, let's say, positive 3.45%. Okay? Got that number? 3.45. Tuck that away for a second.
All right, method number 2, the equal weighted index. And this one is exactly what it sounds like. Every single stock in the index gets the exact same slice of the pie. A tiny little company has just as much say as a massive one. They're all treated equally. And whoa, look at that. Same 3 stocks, we just changed the rules, and now the return is a whopping 10.40%. That's a huge jump. What happened? Well, in our example, the smaller stocks did really well, and this method gave them an equal voice, so their performance had a much bigger impact. What a massive difference, right? Okay, and finally, we've got the big one. This is the most common way to build an index today, market cap weighting. Market cap is just a fancy term for the total value of a company. You take the share price and multiply it by all the shares out there. Simple. This is how the S&P 500 works. And the rule here is, the bigger the company, the bigger its influence on the index. The giants get the biggest say.
And with this method, our return is now just 1.49%. Isn't that wild? Let's just run that back. With the exact same stocks, we got a 3.45% return, then a 10.40% return, and now a 1.49% return. 3 totally different answers to the question, how did the market do?
So this is the big takeaway, right here. It's the same stocks, but different rules, and you get wildly different results. The way an index is built, its weighting, completely changes the story it tells. It proves it's not just about what's in the index, but how much it counts.
Of course, the market never stands still, right? Companies are always changing. They get bigger, they get smaller, they merge, some go bust.
So you can't just build an index and walk away. They need a little maintenance to stay relevant. Let's take a look at how they do that.
So there are really two key things that happen. The first is called rebalancing. Think of this like fine-tuning the recipe. You're just adjusting the weights to get them back to where they're supposed to be. But then you've got reconstitution. This is a much bigger deal. This is swapping out the ingredients entirely. New companies come in, old ones go out, all to make sure the index is still a good reflection of the market.
And this reconstitution process can have a huge effect on a stock's price. I mean, check out this classic example. Traders started whispering that a certain company was about to get added to the big Russell 2000 index, and just the rumor, the anticipation, was enough to send the stock soaring almost 400%. That's because all the funds that have to track that index knew they were going to have to buy it, so they started piling in early.
Okay, so we know what an index is, we know how they're calculated, and we know how they're maintained. So what? Why does any of this matter to you and me? Let's bring it all home.
Well, for one thing, indexes are used for a ton of stuff. They're like a weather report for the market's mood. They're used as building blocks in all sorts of complicated financial models. And maybe most importantly, they're the yardstick. They're the benchmark that all those highly paid active fund managers are measured against. Can they beat the index? If not, what are you paying them for?
But here's probably the biggest reason this matters to you. Indexes are the blueprint for some of the most popular investment products on the planet. Index funds and ETFs. You probably own some in your retirement account right now. And their whole job, their only job, is to do one simple thing: copy an index and deliver its performance to you, usually for a very low cost.
See? From the Dow Jones you hear about on the nightly news, to the S&P 500, all the way to the funds sitting in your 401k, indexes are literally everywhere. But they aren't just numbers, they're stories. And now you know how those stories are written. So the next time somebody says the market was up, you'll know to ask the smart questions. Oh yeah? Which market? And how's it weighted? Knowing the answers to those questions is a huge step toward becoming a smarter, more confident investor. Thanks for joining me.